Good afternoon, everyone, and thank you for being here today. Hope you found the morning interesting, but now we have a treat for you. We have our guest keynote speaker today, and I am very pleased to introduce Patrick Harker to the group. Patrick has a long and distinguished career in academia. I first met him when he was dean at the Wharton School, and I was dean at the University of Rochester back in the 90s sometime. And he then became president of the University of Delaware. And then I asked Pat to join the Fed board in Philadelphia. And he joined our board of directors in 2012. Pretty good. 2012. And of course, now he's the president and CEO of the Federal Reserve Bank of Philadelphia. Not sure how he got that position. I think there was another guy that was there, before that, and Pat seems calm compared to him. But anyway, it is indeed my pleasure to welcome Patrick Harker to the SOMC, and I look forward to his remark. And thank you for being here, Pat.
Thanks, Charlie, so much, and thanks everyone for inviting me here today. One of the great joys of being in this job is being surrounded by all of you, some great experts, economists, policy experts, and because you just help us think differently, right? And I was able to get in and out of some of the sessions this morning, and I really enjoyed the give and take, and then the dinner last night we had here. So it just gives us food for thought, and so I really appreciate that. But on occasions like today, I really sometimes like to take the opportunity to highlight, to frankly brag about some of the work that our staff is doing, whether it's in Philadelphia or around the system, and to highlight that as part of my remarks. But sometimes life makes different choices for us. And so I thought that given the turmoil in the money markets last week, this seems like one of those times where I won't talk about what I was going to talk about, but rather talk about the money markets. So with that in mind, I do want to start, though, with a quick outlook for the economy, and then, as I said, delve into what happened last week and what I think it means. Spoiler alert, it does not affect the stance of monetary policy or, I believe, have a meaningful impact on the economy going forward. Now, I thought I'd get that out of the way right there. That's sort of the bottom line of my remarks. So as I venture into this discussion, of course, there is one thing I need to do, and many of you in this room have heard it, and you've done it. It's the standard Fed disclaimer. These are my remarks alone, and nobody else at the FOMC or in the Federal Reserve System. There, I cannot get in trouble now. So, well, I can get in trouble, but not about that. So with that in place, let's talk about the outlook, the economic outlook. My outlook really hasn't changed a whole lot over the course of the year. The labor market continues to show strength. We're creating jobs above the rate we need to keep pace with growth. And I expect unemployment to stay below the 4% mark for the next couple of years, assuming, of course, economic conditions unfold as we think they're going to unfold. Inflation, we had some conversation about that. Inflation has been persistently below target for some time, but it really does appear to be moving up. Today's report, the core PCE report, is another testament to the fact that we're within shooting distance of the 2% target. Now, it's slow. It's been very slow, but I think we'll get to the 2% target here in the next, say, 18-ish, 24 months. So while the concerns about growth have been amplified lately, I also think the trajectory for growth is on track with our recent forecasts. Consumers continue to be the engine powering growth. Now, we saw a little blip here in the recent report, but we'll see how that plays out over time. And it makes sense, given how strong the labor markets have been. So I continue to see overall GDP growth for 2019, a little above 2%, then trending down to 2% in subsequent years. Now, that said, there are clearly downside risks that many of you talked about in the sessions earlier this morning, mostly posed by trade and international developments, and just this cloud of uncertainty that's hanging around every boardroom in the country right now. It is that uncertainty, I believe, more than anything else, that is affecting business decisions. And we hear this all the time. We hear this again and again from our contacts. And it surfaces not just in our contacts, but you'll see it in the Beige Book. You'll see comments in the Beige Book. And it is showing up now in data on confidence and data on business investment across the economy. This cloud of uncertainty is just affecting everyone. So this leads me to a point I've made before. Fed watchers often note that many of us have themes or phrases we return to. We go back to the oldies but goodies, right? The themes that we know. So two of my most frequent ones are, and I think they actually are very consistent with what Charlie said earlier. It is important to remember that growth is fundamentally the sum of growth of productivity and the labor force, and that monetary policy doesn't have a lot to do about that, right? Second, monetary policy is a relatively blunt tool, and with, as we were discussing earlier, with a relatively limited scope in what it can do. It's not that it's unimportant, it's not that it has no power, but I think we have to recognize that power, that influence on the economy over time is limited. So the Fed, we can pull all the levers available to us to create a more hospitable environment for growth, but trend economic growth is driven by other forces, driven by fiscal policy, for example. Monetary policy can't mitigate risk or move the growth needle in any meaningful way, in my view. Now they've delivered my oratorical calling cards. The issue people care about most, of course, is rates. So my own view is that we should hold firm right now, that we should stay where we are and see how things settle out and watch events play out over the subsequent weeks and months. Just for full disclosure, in December, I was not supportive of the increase. We did have the decrease the meeting before, which I justified as we're getting back to where I thought we should be, but I was not supportive of the cut that we just made. I think we should just hold and see how the economy plays out. So that's where I am on the economy. Generally speaking, using a technical phrase, pretty good. I mean, things, even though there's a lot of noise and a lot of uncertainty, things still seem to be pretty good. So with that in mind, let's turn to the other topic that I think is on everyone's mind. So a quick recap. Last week, there was an unusual stress in the money markets due primarily to funds flowing to the Treasury to meet corporate tax payments and settle Treasury security purchases. As a result, there were significant surges in repurchase repo rates early in the week, which put upward pressure on the effective funds rate, and in fact pushed it above the top of the target range on Tuesday. Now, while interest rate control and market functions are obviously important issues, I want to reiterate my opening note that they neither reflect nor direct the stance of monetary policy, nor do they have implications for the wider economy. It's clear that last week's episode was triggered by the outside flow of private sector funds to the Treasury. But let's step back a little bit. Dates for tax payments and bond settlements should not and are not a surprise. They are fixtures of the fiscal calendar and well known both to policymakers and markets. Everyone was expecting large liquidity flows. The impact, however, was clearly much larger than anyone anticipated, markets included. The repo market took the brunt of the impact as the secured overnight finance rate, SOFR, rose above 5% last Tuesday, with some trades executing at rates as high as 10%. While this was certainly not an average day, I think it's important to note that the repo market did not freeze. The volume of secured overnight finance remains steady at the $1.2 trillion level it has maintained for the past several months. The market did ultimately function. The funding pressures in secured markets passed through to the Fed funds market. The effective Fed funds rate rose to the top of the target range on Monday the 16th and surpassed the top of the range by 5 basis points the next day. That day, Tuesday, the New York Fed's open market trading desk started repurchase operations to stem the pressure on money markets and continued them for the duration of the week. Additionally, 2 technical adjustments were agreed upon at last week's FOMC meeting. First, the interest paid on reserves was set at 20 basis points below the top of the target range, and second, the overnight reverse repo rate was set 5 basis points below the bottom of the target range. Those measures, I believe, successfully relieved funding pressures, and the effective Fed funds not only moved back within the target range, it came down to 10 basis points below the range's ceiling that Thursday and has remained there since. Conditions are starting to normalize in the repo markets as well, with repo rates drifting lower on Thursday and Friday, and starting this week around 1.85%. In fact, before I came up here, I checked, and that's roughly where they were, at least in the morning. In fact, there's a significant drop in the fraction of volume in the Fed funds market that traded at rates above the target range. For instance, less than 1% of total Fed funds volume was priced outside the target range. On Friday, the desk announced it would initiate a series of repo operations, including several term operations, to help keep the Fed funds rate within the target range. Those operations will continue until October 10th. We've seen strong demand for repo operations this week, possibly indicating that funding pressures may return on quarter end, and the desk stepped up operations limits yesterday. As Chair Powell noted in his post-meeting press conference, we will continue to monitor market developments and adjust operations as necessary to ensure that rates in the Fed funds market stay within the target range. So that's the situation where we are today. The obvious question that arises, and indeed has been asked, is why? I mean, what are the likely suspects? And one of those suspects is the current level of reserves. Is the current level of reserves appropriate? And whether the Fed needs to expand our toolkit better to manage interest rates. That's been floating around. I don't think we can actually answer or adequately answer those questions without first taking a step back and seeing them in a wider context. As you know, earlier this year, the FOMC decided it would continue to conduct monetary policy in a regime of ample reserves, in which the setting of administered rates acts as our primary policy tool, and the supply of reserves does not need to be, as a result, actively managed. Shortly after that, we announced our plan to cease asset redemptions and hold the balance sheet to roughly its post-redemption size. As currency and other non-reserve liabilities grow, aggregate reserves see a natural, gradual decline. Our end game was for the reserves to reach a level, quote, consistent with efficient and effective implementation of monetary policy, end quote. Now, there were two primary objectives to this approach. First was to reduce uncertainty about asset purchases by announcing our plans well in advance. Second, to approach the necessary levels of reserves, which itself is suffused with uncertainty, with a great abundance of caution. Now, we only have estimates of the demand for reserves, though we've conducted a great deal of research around the Federal Reserve System, including continued conversations with market participants. In fact, the staff at the Philadelphia and New York Feds were among the first to identify that the need for reserves could be much larger than many anticipated. So to be on the safe side, it made sense to move slowly, buying time to carefully observe market developments and better assess their implications. That is, we gave ourselves time for the inevitable unknown unknowns of life, like the one that occurred last week, just to pick an entirely random example. We knew that something like this was possible, and so we wanted to prepare for that by moving slowly. In fact, while they may appear jarring at the moment, these movements jarring in the moment, temporary episodes like this have happened in the past, as Charlie said, and they do offer a host of information and insight. It is very possible that our reserves are near or approaching their appropriate level. That is, as the Philadelphia and New York Fed's research noted, it might be on the higher end of our estimates. If that's the case, we may, and I emphasize may, need to resume the organic growth of the balance sheet earlier than anticipated. So we'll continue to monitor and assess money market conditions and act as necessary to ensure interest rate control. But I think a central question is why liquidity did not flow smoothly to where it was needed most. Again, echoing some of the conversation we were having earlier. So I'll once again spare you any suspense. I really, in this area, have more questions than answers. I think it's important to avoid jumping to conclusions, and I certainly wouldn't write any prescriptions, policy or otherwise, before we know what ailed the markets. In the oft-used analogy of money markets as plumbing, we should ask, and I think we are asking, whether some pipes might be rusted or clogged, or if more pipes might be needed. It's also worth asking if regulation might be contributing to any erosion or blockage in those pipes that might exist. The second question is whether the Fed ought to expand our toolkit. As many of you have noted from the June FOMC minutes, there was a discussion about the possibility of a standing repo facility. In theory, this could provide a backstop against the unusual spikes in the Fed funds and other money market rates. Now, these discussions, I need to say, are in their infancy, and there is more work to be done, particularly in considering how such a facility would be designed, what are the objectives of such a facility, and what its net benefits would be relative to alternative approaches. So all in all, I see three takeaways from this interlude. First, in the face of unexpected turmoil, the Fed took swift and appropriate action, and it appears to have had its desired effect. Second, the element of surprise suggested some deeper issues may be at play. And third, that the Fed is committed to do what it takes to maintain interest rate control, and we will continue to keep a watchful eye. With that, let me finish and open the floor up for questions. Yes, sir. Mike's coming.
Hi, I'm Doug Carr. Thank you for that presentation. In exploring why there's this greater need for reserves, we heard last SOMC session that regulatory pressures were a big factor in that. But what about also the connection between your balance sheet and interest rates? We have people come in here and they say, well, we've got our balance sheet policy and our interest rate policy. And it used to be that they were joined at the hip. You used your balance sheet to control interest rates.
Right.
There's a measurable effect statistically now. Do you see a connection, and what could you do about it?
So let me start with what the desired goal is to keep that separation, right? So that the balance sheet, the plan all along was for the balance sheet to shrink down to this level we thought was appropriate, to go flat for a while, right? And just let the reserves run off with organic growth of particularly currency, and then start to grow with that currency growth. So that's still the goal. I want to emphasize, though, not so much for people here, but maybe people who are not here somewhere else, as we start that growth again, this is not QE4. Right? I want to make this clear. This is not a monetary policy tool. We're just growing with the level of currency. And so I need to really emphasize that, because that's out in the ether. People are talking this way, and I think we just have to make that very clear. So that's the goal. Now, in executing that goal, are we achieving that, or that decoupling, right? That's what we need to try to understand more, right? So, because if that's not the case, the engineer in me says, well, let's go back to the drawing board and let's design it so that we make sure that we can try to create that, to the extent we can, try to make that decoupling happen. That is the goal. Yes, in the back, and then I'll come here. We'll move up the room.
Nisa Abouaf, question related to the volatility of the repos. Part A is that may the issue be related to the firing of the relevant people that had the human capital to deal with the market volatility?
Yeah.
And part B is the quantity of reserves that moved to the Treasury equal to the quantity of reserves that was eventually supplied by the Fed?
So that question is still open. First, I don't think it had anything to do with our human capital, our skills. It's a deep bench of expertise in New York. I just don't think that's the issue. On the flow of reserves, let me sort of step back and answer the question a slightly different way. There are a couple of likely suspects for what happened. Reserve level is one. Second is what you're alluding to, is as the Treasury is issuing, people need cash, right? And so that added to it, and we're issuing a lot right now. The third issue, though, which is still a bit of an issue for us that we need to understand, and I think these comments were made earlier, just before lunch. There are a lot of reserves in the system, but people were, for a variety of reasons, not willing to trade them. And so those current, as you know, the 5 large institutions have 90% of total reserves. So the question is, what held them back from participating in this market. It could be regulation. It could be, for example, I'll just use an example. We have tried to make it very clear for high-quality liquid assets that Treasury and reserves are equivalent. Whether people believe that or not is a different question, right? And so even though we state something, doesn't mean necessarily that's what people hear, right? I get this from my significant others all the time, right? So just because you didn't hear me, so that's true. So we need to understand that issue, whether it was the Treasury issuance. There's a whole host of issues that we need to address. On the specific question of the flow in and out of Treasury, I don't know the specific answer to that question right now, but I can tell you right now, the markets are, the last couple of days, people did not take full advantage of the facility, except for the 14-day, the term. They did take advantage of that, but generally, we're seeing markets really calm down. Exactly, though, why? That's why I think we have time. My view is we've got tools at our disposal. We just deployed them. We can deploy them again at quarter end or whenever this happens. Rather than, as I said earlier, rather than rush to judgment of what was the cause, let's really take some time, because we have the time. There's no rush to judgment right now. Yes, what else?
I wonder if you could just embellish a little bit around your position, why you think, and what are the conditions that are leading you to believe that the Fed should hold firm now on policy?
Well, I can flip the question, right? Why? And some of my colleagues have articulated the opposite view. So I'll give you my own view. Again, I'll emphasize my own view. I think we're probably pretty close to neutral, if not at. You never know for sure, but we're pretty close to neutral. All the real economy indicators that we can measure, perfectly or imperfectly, really point to an economy that continues its path towards trend growth, right? So the question, it's interesting to me. If I go back about a year ago, the conversation was all about creating policy space. When was the last time you heard that phrase, right? So what are the risks? The risks are that inflation expectations could become unanchored. That is a real risk. Right now, given that we're seeing some, like the PCE print today, I think that risk is there, but it's not elevated in any significant way, right? So labor's doing fine, going to trend growth. So you have to ask yourself, why cut? And then this comes up with the question of insurance. Well, this is where I am a skeptic, I have to say. I don't see any company that I've talked to, anybody that I have any contact with, or I put my hat on my own experience before this job on corporate boards, a large multinational chemical company before this. The reason people aren't investing in business investment has nothing to do with the cost of capital, in my view. If it does, if 25 basis points is going to make the difference between a project going or not going, you need better projects. Okay. I mean, that can't be the reason people aren't investing. It's just this uncertainty. Why would you make a bet on a multi-billion-dollar plant right now for export when you don't know how the winds are going to blow? You just don't. So you sit, you wait, you do other things, right? So I just think a 25, 50 basis point cut won't have a big effect. We'll pull that lever and very little will happen. I mean, we're already seeing, okay, people will argue, well, housing. We're already seeing the refi and the new home purchases because the long end of the curve's already gone down, right? And so mortgage rates have already come down. Again, there could be some mechanism in the long run. I just don't see it right now again, this goes back to my analogy about if the patient's ill, you got to give them the right cure. And I think right now, and this gets back to the questions we were having earlier about humility of central bankers. I think the issues that we're facing right now in the economy have little to do, I won't say none, but little to do with the stance of monetary policy right now. I just don't believe that. And so I think the best thing for us to do is to let the economy ride. It's a good economy and see how things shake out. Yeah, here and then Mickey.
Hi, I'm Harry Follick, working with New York State. What do you think the Federal Reserve should say if an important public official of the United States says to them, you can afford to lower interest rates because the Europeans and Asians have a competitive advantage because their interest rates are actually lower than ours. It makes our currency somewhat stronger than it really needs to be. And in general, it gives them an advantage over us.
So, generally, I ignore any of those comments, and I just try to look at the facts, right, and where we are. Clearly, there's that channel, right, that is affecting. But I don't think, again, go back to where's that going to affect our trade stance? There is some evidence that is having an effect, but I think that's just being swamped by this uncertainty that everybody's facing. So, yeah, I mean, we could do a race to the bottom of lower and lower rates. That has costs, though. I mean, real costs. So it's not as though this is free to do such a thing. And I think bouncing off the risks, that's my position, is to stay the course.
Andy Levin earlier argued for stress testing the Fed to different scenarios, and so I have, and by the way, I believe the stress tests on SIFIs have been burdensome but very successful. So when we think about stress testing the Fed, could you comment on the particular issue of the repo markets and the short-term funding markets, and how you would think about a stress test that would allow you to plan, adjust your toolbox, et cetera, in anticipation of what may be needed? And secondly, what do you think in general about stress tests of the Fed?
So, I mean, I think we do a version of that anyway, but I understand your point. So let's think about the future Fed a little bit, where we want to go. In terms of the balance sheet, we've not made any final decisions, but I think there's a general consensus, and I can tell you where I am. I think it's appropriate to go to a Treasury-only or heavy Treasury portfolio. I mean, and just get out of the MBS, or maybe keep a little bit just for operational purposes. I don't know the answer to that, but I think, so at that point, then you just look at our holdings. Okay, that part of the stress test is pretty obvious, right? We're holding treasuries. The then question of the operational kind of stress test you're talking about with the repo market and so forth. Yeah, I think there's some advantage, but I think we're trying to do some of that now through our research capability. But the question of putting a formal stress test model in place, it's an intriguing idea, but I think it needs a lot more work before I would have a strong opinion either way. And I'd missed Andy's comment, so I don't know the specifics of what he was talking about. Yes. Oh, wait, Charlie, right up front here.
I want to come back to this comment that you made in your speech about rusty pipes in the money market, which I found extremely interesting. And I want to ask you about where you think the destination is for operational Fed policies, what the future of the Fed funds market is. So yeah. I'll put it sort of provocatively. There are a lot of people speculating now that the Fed's going to move to a very narrow corridor system based on repo and interest on reserves. Some of us think that part of the problem, the rusty pipes, is that we've gotten rid of uncollateralized lending across banks, so that capability is now gone from the money market, which was part of the rusty. I think that's the rusty pipe.
That's fair, very fair.
And it also is good to have banks looking at each other and looking at their creditworthiness just as a kind of healthy thing in the financial system. So I'm very worried about the movement toward a corridor based only on collateralized interactions among banks. And I wondered whether that's where you were headed.
No, so I think that is a question in my mind on the table. Right now, the committee has made it very clear that we're comfortable with operating in the floor system. We know that through the crisis. But I do think as the level of reserves comes down, it does raise the issue of who's trading in it's a very thin market right now, as you said, in the Fed funds market. So how would you enhance that in any meaningful way? I think that is a question that is worthy of further discussion. I don't have an answer for it right now, but the same question will apply, and that's why I alluded to it with the standing repo facility. Say we don't do that, but we put what is that standing repo facility? Who are the counterparties? If we have a limited set of counterparties, that could have similar consequences, right, as opposed to a broader set of counterparties. What are the parameters of that? One of the things I would not like to see is us disintermediating the private markets in this, right? Because I think that, so we'd have to think carefully about, how we design such a facility. But I think there's not a lot of muscle right now, not just at the Fed, but within the banks with respect to trading. So I think it's a question that's worthy of conversation. I don't have a specific answer because, again, like anything, like Charlie said earlier, there are pros and cons to everything. There are unintended consequences to everything we do. We'd have to think about that. Right now, the committee is very clear on what we stand for, but I think it's always worth revisiting that over time. No question about it. One more. Yes, back here. Yes, please.
On a different subject, on MMT, assuming we get a Warren administration or some other Democratic, candidate becoming president and decides to do this huge spending program, trying to put the pressure on the Fed to monetize the government spending, how would the Treasury be able to pressure the Fed, which has its independence to go along? Would the Fed then just push back and tell the government, be my guest and see what happens in the actual market and then be forced into QE?
So I'm not the Fed, right? I'm one cog in the wheel of the Fed. So I can't answer that question exactly, except to say two things, and I can only speak for myself. One, I do think this is a dangerous path we're on to continue to just spend money. You're seeing it all across the economy. And forget the federal level for a minute. Just go to any state. Talk to any governor in any state. Once they figure their pension obligations, keeping the lights on in the prisons and schools, right? There's not a lot of money left. And this is in one of the best economies we've ever seen. And so we're not investing. And you see this, I was talking to Mickey earlier about this. I'm a former president of a public university. When I started, the contribution of the state to our public university was in double digits. When I left, it was single digits. Now, you can say, because they didn't like me, but I don't think that was the point. It was easy during the crisis to tell us to raise tuition. And at the same time we're doing this, we're telling everybody in America, you need better skills, you need higher skills, you need to get more education. And the one place in America that we provide where people can go and get that in an affordable way, public universities, we're starving. This is a personal pet peeve of mine. But I understand it from a governor's perspective. Like, what am I supposed to do? These pension obligations are killing me, right? So, go back to MMT. I have a very simple view of this. So, if the theory is we're going to invest in the productive capacity of the economy and we're going to get a return greater than the cost of capital, okay. So tell me what we're going to invest in that's going to produce 80% of the budget, I would argue, has little to do with increasing the productive capacity of America, the federal budget. If we're going to spend more on that, we're not going to get that return. It's just not, it just doesn't add up. So beyond whether the Fed would fund this or not, I think we have to ask a more fundamental question. Is this even a good idea? And I just think it's a dangerous idea to go down this path because I don't see how the math works, right? Given what we know about what we'd invest in. I just don't see it.
Pat, thank you very much. It's a pleasure to have all of you. Pat.